Hello, today I'd like to talk about personal super contributions and whether they might be suitable for you. A lot of people know they can put extra money into their super fund, but many people are not sure when it makes sense and when it doesn't. Let's start it. Normally, your employer pays super for you. However, you can also put your own money into your super fund, depending on your situation. This may be tax benefits or even government incentive available, but it's important to understand that this strategy is not suitable for everyone. Let's talk about the higher income earners first. If you earn over $100,000 per year and are thinking about making a personal deductible super contribution, I would recommend checking your concessional contribution cap first. For the 2025 to 2026 financial year, the concessional contribution cap is $30,000. This cap includes both your employer super contributions and any personal deductible contributions you make. You may also have unused concessional contribution cap from previous years that can be carried forward if you are eligible. Before making a large contribution, it's a good idea to log into your MyGov account and check your available contribution cap through ATO. If you contribute too much and exceed your cap, don't panic. I've seen clients receive ATO letters after making excess super contribution. The ATO will generally add the excess amount back into your taxable income and may charge additional tax and interest. In many cases, the ATO will give you two options. You can choose to release the money from super fund to help you to pay the additional tax, or you can leave the money in super and pay the tax by yourself. It's not the end of the world, but it's much easier to check your available cap before making a large contribution. Now let's talk about lower income earners. There is another government incentive called super co-contribution. For the 2025 to 2026 financial year, if your income is around $47,500 or less, you put $1,000 of your own after-tax money into your super fund without claiming a tax deduction. The government may contribute an extra $500 into your super account. In simple terms, you put in $1,000 and the government may add another $500. Okay, as your income increases above this level, the government contribution gradually reduces. Once your income reaches around $62,500, the co-contribution generally stops. There's no co-contribution at all. One important thing to remember is if you want the government co-contribution, the money must be non-deductible contribution. If you claim a tax deduction for that $1,000 contribution, it generally will not qualify for the government co-contribution. This is one of the most common areas of the confusion. So make sure you understand which benefit you are aiming for before making the contribution. Another important point is that simply transferring money into your super fund doesn't automatically create a tax deduction. If you want to claim a deduction, you must submit a notice of intent to claim the deduction form to your super fund and receive confirmation from the super fund before lodging the tax return. Without this step, the contribution may not be deductible. So, how do you submit the notice of intent form? In most cases, it's actually quite simple. You can Google your super fund's name together with the claim deduction or notice of intent. Most super funds allow you to complete the form online through your member account. Alternatively, you can download a paper form, complete it, and send it to your super fund. Remember, you submit this form to the super fund, not to the ATO. Your super fund must acknowledge the form before you claim the deduction into your tax return. Also, remember the contribution must generally be received by your super fund before 30th June if you want to claim the deduction in that financial year. As with many tax planning strategies, there's no one-size-fits-all answer. Some people may benefit more from a tax deduction, as others may benefit more from government co-contribution. The best option depends on your income, your available contribution caps, and your personal circumstance. I hope this video can help you better understand how personal contribution works in Australia. Thanks for watching.